Well, Matt, good to see you. Happy Friday, or it's about to be. It's getting happier and happier by the minute. Uh, Wild
We
Thursday
just got
though.
happy because we're back together.
Well, that's the thing. I mean, that's why I said it's going to get happier. I mean, everything from 1 o'clock Eastern on, it's just it's all uphill from there or downhill from there. I never know how to say that, uphill or downhill. Downhill is easier, but when you say downhill, that kind of sounds like everything's going negative. My Friday gets progressively better after this point because I get 30 minutes or so with you. And then usually after you, I don't really have much else going on the rest of the day. So it's right into the weekend. You always tell me to start the weekend off strong. So I usually do it right after the show. So the beginning of a happy Friday starting now.
Well, there you go. Your heart, what matters, your heart is happy.
That's right.
And,
Not a
and
happy Thursday though yesterday. And it sounds like when you were just running through a list of things that we could talk about, this is going to have to be like rapid fire if we're going to get all those topics in 30 minutes. So what happened yesterday?
I don't know. I forgot how to do the market thing yesterday. I'm serious. So yesterday was a big giant slice of steaming fly-filled humble pie. And if it's full of flies, you know what it tasted like. So
I can imagine.
yeah. So of course we've always been long the AI trade. We're long TSM. We're long obviously Google, Microsoft, and our core position, our largest position is Nvidia. So we had $1.31 price target on earnings for yesterday for when they came out Wednesday. Street consensus was $1.25. It came in at $1.30. So solid earnings, phenomenal guidance. You know they're going to earn $9 a share next year with ease. So there's nothing fundamentally wrong, and that was kind of obviously they're the biggest single component weighted component on the S&P 500. So it was kind of the last data point for the earnings season, okay, before the Federal Reserve has its meeting. So it was obviously, and the government, has turned back on. We got the jobs data report from September, which actually showed to be pretty strong. Okay, 119,000 jobs on 50,000 consensus. However, we had significantly increased labor force participation, which means there's a lot. So we had, although we 2.5x almost 2.5x, 2.4x are the estimates for job growth for the month of September. Unemployment went up from 4.3 to 4.4. Okay, because of labor force participation went up. So a lot more people are out looking for jobs. So what that tells us is a lot of people are trying to find jobs, and the labor market is sort of at stall speed. Okay, people are trying to find jobs. The jobs are trying to find. And I heard Richard Daly talking about this the other day on a podcast with Goldman Sachs. Boy, they're having the problem that they're having is a matching problem. Okay, so there's a lot of people looking for work that can't find work right now, college graduates specifically. But there's a lot of jobs that can't be filled. Okay, so if you come, you've graduated from Vanderbilt or Stony Brook or one of these places with a master's in business or something like that, that's great. You're gonna have a hard time finding a job. But however, if you want to go be a window installer, you're covered. So that's what they in the labor market economics is called matching. So there's a little bit of a matching problem. So I think hopefully cuts will kind of alleviate some of that. So there's all these sort of data points now that are coming in that are just moving the interest rate, the potential of a rate cut for December all over the place. Remember last month, a month ago, it was 96% chance of a rate cut for the December meeting. It went all the way down to 30 on Wednesday, 30%. Okay. Wow. It's back up to 70 now. So, and I think that has a lot to do with the market motions right now. But back to Nvidia. Nvidia's, here it is. It's going to earn $10 a share next year. It obviously blew the cover off the ball, and they provided very high guidance into that quarter and still beat it. Okay, but we're buying. It went down to it's basically $180 a share. You're buying Nvidia for 20 times earnings, with growth rates of 40-50%. I mean, that's a layup if I ever heard it. So when the market does what it did yesterday, it's almost like one of those. You ever seen like a motorcycle? It's just going along smoothly, and all of a sudden it just, for no reason, maybe something minor, and the front wheel just starts to do what they call a harmonic oscillation. That's what
I've never
I
heard
think
it called that, but yeah.
it's just it's almost like a harmonic, like it's like a frequency type thing. It just kind of boom, 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 and it kind of just moves. It's an energy transfer oscillation or whatever it is. I think that's all I can really attribute this to. The market did really, really well. It met every threshold it needed to meet. And then people just said, okay, well, it can't really get much better from here. And they just kind of sold off. But again, back to our last show, we talked about if we get a pullback, it's going to be relatively contained. Okay. Because there's so many bears. Right now, net bears are what, 20% right now. We have bulls at 32.5 and bears at 43. Last week it was 49 and 31. So we have a 10% net bears, and we've got last week we had 17% net bears. So we don't have net bulls at all. Normally, when we get a 30% spread on bulls, that's when the market is very overvalued. Okay, we don't have any of that. We have RSI at 34. Okay, we're getting into super oversold territory. So that tells me a lot of this has already been contained. So back to we don't time the market, we price the market. I allocated those new dollars in on Tuesday. So we allocated them at 65.90 on S&P 22 and at 22.2 on the Nasdaq. Okay, mostly we're Nasdaq. And the reason I did that had nothing to do with the time. It had to do with the price. As Nasdaq earnings are coming in, and this is as of Tuesday or Wednesday when we allocated into the market, is I looked at Nasdaq earnings for 2027 because we're trying to skate to where the puck is going, not to where the puck is. So 2026, that's mostly priced in now. We want to start pricing in 2027 earnings. So we started looking at Nasdaq 2027 earnings, and just the acceleration in earnings for the Nasdaq has been nothing short of phenomenal. In July, when we stopped allocating new dollars at 21,000 on the Nasdaq, so the Nasdaq was at 21,000. We had 2027 earnings sitting at 921. Okay, when I allocated this week at 22.2, we had Nasdaq earnings at 996. Okay, an 8% jump. This morning, it jumped again. It's at $1,005 a share. So I actually bought 2027 at a cheaper price than I would have in July, albeit at a higher price, but a cheaper price, if that makes sense. So, timing the market is a dangerous game. Pricing the market is a little bit better, but pricing the market and using valuation is never a good timing tool. It never has been and never will be. Okay, it's just more of a risk mitigation tool. Okay, so based on the acceleration of earnings, based on where the market was, these earnings can get away from us based on how bearish people already kind of are. I don't know that we're going to get a lot more traction with a large pullback into a 19,000 level Nasdaq or something like that. So at this point in time, the earnings are strong enough, out in the future to where it looks like a good risk reward paradigm for us.
I want to have you dig in just a little bit more, and I know we've talked about this before, but for anyone who may have just caught what you just said, you may have confused the absolute crap out of them when you said we got a better price, even though it was a higher price. It was a better price. To a lot of people, that sounds like that makes no sense. I know it does, and I get it, but let's educate a little bit more on that line, on that what you just said there, because how do we get a better price even though it was a higher price?
So the price of the market in July. So I started looking at things toward the end of not the following year, but the year after that, usually the middle of the year. And we were sitting at basically 23 times 2027 earnings. Okay. With barely any movement. And we just remember in the spring, we started talking about little upticks in earnings revisions, just small upticks. At the time, of course, we didn't know how far or how fast they were going to go, if any further at all. So at 21,000 on the NASDAQ with $920 a share priced in for 2027, that is a pretty expensive scenario, right? We're about 23 times 2027 earnings in the middle of 2025. So we're talking about 18 months out. We're buying that at 23 times earnings. Okay. That's a long time. That's a lot of duration for that multiple. Okay. Because as the duration grows, the multiple should shrink. That's the idea. So as I started to watch earnings revisions start to continue to tick up, and not just tick up, but kind of accelerate, and we started to see this bearish positioning take place, especially with the government shutdown and whatever. It kind of looked like the fundamentals are incredibly strong and getting stronger, but the bears don't believe it. The bears think things are all going to go, to hell in a handbasket here. So we don't have a lot of sellers, because we're not coming away from a very bullish stance right now. We're coming from a very kind of a bearish stance. In fact, Tom Lee says it every single day. He said, this is the most hated V-shaped rally, talking about the April lows to today. And he's 100% correct. It's the most hated V-shaped rally. People, they don't want this they want it to fail, or they think it's going to fail. It's not going to fail. The fundamentals are too strong. So back to the original question here is, we've seen here we are basically 13 months away from end of 2027. So we have a shorter duration. So we should have a higher multiple. But now we're at $1,005 a share, buying it so $1,005 a share at 22.2 is a 22 times multiple. So now we have a 22 times multiple at 13 months. That makes sense to me. So that is a lot less risk, and it's a better price package, I guess you might say, than buying it at 23 times earnings. I know that's only one multiple turn, but it's one multiple turn, and it's basically a 4 to 5 month differential. Okay. So, and again, earnings are accelerating. 2 days ago, NASDAQ earnings 2027 were 995. They've jumped to 1,005. Okay. We were looking at 346 a share 4 or 5 days ago on S&P earnings for 2027. We're at 351. So we're just seeing this acceleration happen. And back to the Federal Reserve, I still think there's going to be a cut in December. I maintain it. I think next year, 3 cuts, I think, is going to be more of the ambitious case. So remember, this year we were 3 plus or minus 1. Mm-hmm. So we're going into next year with 2 plus or minus 1. Okay. But 2 is our base case for next year. So we had the fear greed index on yesterday go to 7. Okay. So that's that fear greed index that CNN puts out, and it's actually pretty cool.
What's the range on that for context?
0 to 100. Okay.
Oh, wow.
0 to 100. So yeah. So if you look at it, let me see here. Hang on. So what we've seen here is you have extreme greed. That's obviously 100, and extreme fear. So to put it into perspective, the April low, plunge of April low, the lowest I've ever seen it is 3. That was it.
So we're at 7 now. So essentially,
we were at 7 yesterday. We're at 10 today.
100
so
being the most optimistic.
So much fear already baked into this market. And again, back to the containment of this pullback. And as you can see today, the Dow it was up 750 earlier. It's down to 450, up 450 now. NASDAQ was up, I think, about 150 points. I think it's probably getting close to flat again. But nonetheless, we're starting to, the market is making its decision. The market is going through its debate right now. But I think, if you look at the foundation for the study of cycles, and one of their composites that actually Mark Newton puts together, he's really great at cycles. He sees sort of an intermediate cycle that bottoms right about into the end part of November here, that then turns up into December, and it's pretty good, and a lot of it's based on these tech companies. So that's kind of what we're thinking this is. And again, the relative strength index is down to 34. This looks like to be getting close to the oversold, and we don't have anything structurally wrong. In fact, if anything, we have the opposite. So, there's been a few hints, some conjecture on what caused it yesterday. One I thought was interesting, to say the least, was there was a tweet put out by President Trump yesterday at 10:21, talking about, like, if there, I guess, I'm not political, but I guess some Democrats said something about the Air Force people or to the military about, not following orders, not following the president's order. I don't know what it was. Okay. I haven't looked into it yet, so my apologies. But they coined it as seditious behavior. Okay. That being said, he put a tweet out about seditious behavior is punishable by death. And 10 minutes later, the market started to just sell off. It was 10 minutes. So who knows? So the other thing is the.
Is that a good? Not.
I don't.
Is that a good reason to sell? Is that one tweet worth 3% of U.S. market capitalization? I know that we've talked about how his words carry a lot of weight, but that's
yeah. But I guess if you look at it, his words do carry a lot of weight, and you're talking about a sitting president talking about sitting senators. I believe these were sitting U.S. senators, 6 of them, talking about their behavior is going to get the death penalty. And again, we're the world reserve currency and all these other things. So I don't know. I'm speculating like anyone else. It was something that was floated out there. Another I thought was interesting was the Epstein files. That this was also released yesterday. That was signed into the transparency files. That it's not so much the politicians, it's the billionaire investor donor people that are in there. And they may have pulled back a little bit because they need to sort of protect their assets. I've heard that. That's how, I guess the point I'm trying to make is there was no real good reason for what happened yesterday. Yeah. And we're trying to find something. And now we're looking at, the president threatening senators and the Epstein files because I can't give you a mathematical purpose for what took place yesterday, other than people just the machine started to sell. Actually, Josh Brown on CNBC said something really, really good today. He said this was machines selling against other machines that are programmed by a third machine. These are machines working, basically working against each other, but programmed by something other machine. So we're not talking about logical behavior here. We're talking about rules-based mathematics.
What percentage of trading volume at this point is human versus machines? Do you happen to know that, or anyone in the ballpark?
I want to say it's about 70% machines now.
Does that concern you? That concerns me. I think that 70% of trading activity is not to say. I don't know. The irrational behavior of humans is also dangerous for the market. I get that, but it's also something that you have to kind of count on, I think, as a trader, as an investor. So I don't know. It's odd to me when you start thinking about the majority. Said another way, when you place a trade for your clients, 70% of the time you're buying or selling from a machine. Isn't that fairly close to accurate based on that number? On the other side of that trade.
I'm buying from probably a market maker or whomever, so I'm buying it at market price. I'm not buying against a program machine, right? So I guess what I'm saying, these algorithmic machines, what they do is they see price points and they start to sell. Other machines and see these market levels, these different thresholds, and as they pass through them, it then generates another sell signal, which then generates another sell, which takes it to another threshold, which then generates another sell signal on a different machine somewhere else. And then it just starts to cascade on itself. So that scenario, which is, I guarantee you that's exactly what happened yesterday. This was not human selling yesterday. This was machine selling yesterday. There was no doubt about that. That was the machines yesterday. That what happened yesterday is quite concerning, because we're talking about retirees and people living off these, their investments. And machines can, they don't have a I love you bone. They don't. Okay. They have we're a machine bone. And it hit the number. It's now the number. So it's going to now transact whatever it needs to transact, whatever's maybe it's 3% of the portfolio. Maybe it's 2% of the portfolio. Maybe it's 20% of a certain sector of the portfolio, whatever that may be. Okay. So that is concerning. So hopefully at some point in time, that will be addressed, through legislation.
Well, how does it change anything to you, right? If the fact that machines are, because at the end of the day, machines can create a short-term blip in the market, gave you a buying opportunity. It also can go the other direction. Does that change anything about the way you do as machine trading becomes more and more common? Does that do anything to your process for portfolio, strategic decisions with the portfolios?
Yes and no. So yes, just exactly how you worded it. It provides opportunity, and we took it. We took it because there was no reason for that pullback yesterday. Okay. There was no real reason for it to get to 65.90 or 22.2, but it happened. Okay. Because of the machine selling during the week. And I took that opportunity. But as far as does it impact my longer term portfolio construction? Absolutely not. Because we're getting into obviously earnings and what parts of the economy are growing and what parts of the economy are not growing. And okay, let's go to the parts of the economy that are growing. What sectors? Let's look into those sectors. Let's look into the strongest companies, strongest growth companies, those sectors, and pay the best price we can for their future earnings. Okay, so it doesn't change. But what to allocate? That's a fundamental factor. That's a fundamental reason. When to allocate? That's typically a technical. That happens on a technical basis. Okay, and the technicals are highly influenced by machine trading. So there is a little.
Back to some of the core of the conversation from a few minutes ago. In every market's a little bit different. Every market cycle is a little bit different, but we are still very, very close to all-time highs. I mean, we're not that far off. Mm-hmm. So typically, and I'm not going to say, typically can be a pretty broad definition, right? Typically can mean 99% of the time, or it can mean 51% of the time, technically. So I'm not sure exactly. It's not a universal truth in every market, but typically you tend to see the fear indexes go up when we're way down, and the greed indexes go way up when we're near the tops. So to hear that we're 3, 4, 5% off of the all-time highs, and we're at a 7% fear index on or 7% optimism, maybe would be a way of putting that. That just seems, it's almost like the market, those indexes are actually rationally buying low, selling high for a change, and thinking, no, I don't want, I'm scared to buy right now because the price is so high. Usually people are more afraid to get into the markets when we've had a big drop. How uncommon is that? And what do you think? We've kind of talked about it a little bit there, but is that, what does that mean? I guess that we have both of those things happening at the same time.
Well, again, that's the machines trading against each other, right? Some are designed to sell at certain numbers, some are designed to buy at other numbers. So who's to say, right? But that being said, I had an interesting conversation with the team this morning. I said, everyone was selling, and I said I was telling the advisory yesterday. I said, get on the horn with the clients right now. I know we have some new dollars that are coming in. Some clients sold their companies or whatever. It needs to get here right now. We got an opportunity. Okay, we got an opportunity. And this morning I said, doing what we do, I think trying to be good at what we do, you have to think backwards, upside down, and into the future. It's true. Things look so good out there, but things look so bad today. That's what we love. We love a terrible market in a wonderful economy, which is what we got a few days this week. Okay. Terrible market action in a great, strong economy. What we don't like is an over exuberant market in a contracting economy, a worsening economy. Okay. That's you can make the case that also is happening. Like, well, we're at all-time highs and the labor market is at stall speed right now. So are we, can you make that case? You could. I'm not buying that case. I'm looking at future earnings and thinking they're okay. Okay. And I do believe the Fed will get ahead of this thing and keep the labor market from deteriorating because, inflation is for the most part contained. So, it's hard to do. And for me, it took a long time to really understand the backwards contrarian nature of how the market actually functions. If you want to take advantage of the opportunities. In fact, one of the things I've said here on the show and told the team multiple times, if you're buying when it feels good, You're not going to make any money. Okay. If you're buying because you're sure of something, you're not going to make any money. Okay.
Yeah.
Now let's go back to the summertime. We were at all-time highs, 6,300, 6,350. We get into August. We're going into what's looking like a government shutdown. Okay. Again, all-time highs. And the market has gotten out of its what's called the Keltner channel. It's highly overbought. Okay. Going into August, September, October, that crunch time of the year where all the volatility happens and the sell-offs take place. So I'm like, we're easily going to get a 7, 8, 9%. I said it on the show.
Yeah.
I said it on the show from the beginning of August all the way through until probably last week. It never materialized. It just never, ever did. And why?
Yeah.
Because I was sure it was going to.
Yeah, that's a good point.
See what I'm saying? Like,
So
when you start thinking that something's absolutely going to happen, well, then you can almost be sure it's not going to happen. So then you have to start using the other side of the backward side. You bring, okay, so it's not going to happen. What is going to happen? And then you just fall into a dark corner and start to drool and eat crackers. So, which is what I do most of the day anyway.
Yeah, it's
I got some on my shirt.
It's funny because typically I would think, okay, when I know there's a school of thought, I think maybe Jim Cramer had this in one of his books or something, but it's a true thing. When the market goes down on good news, that's a sign that we may have, there's, like you said earlier, it's not going to get any better than this. We might as well go ahead and sell it because this is the last bit of good news that we can have. And now we're going to go down. That's like the beginning of the end, maybe for a good market, except when you put that on top of the fact that we were already scared to death to enter the market anyway, that makes that no longer true. And it becomes a buying opportunity, right? But at the same time, you can say that the total opposite way and say, we're scared to death and the market hasn't even started dropping yet. Imagine how scared we're going to be when it does start dropping, right? So you can make a case. That's what makes a market, I guess, for both sides of the argument. But it's funny because I think it's pretty uncommon that I'm not saying it's never happened before, but I think it's pretty uncommon when you have this hated of a rally. It really is. It's like human beings or machines or whoever your market participants have finally started to say, it's like we're actually exercising discipline and saying, I don't know if I want to get in at these prices because they're actually kind of high, but that's not the way it usually plays itself out. And I think you're right. That would normally, even as I say that, it kind of makes me sound like it's a kind of a bearish case, but it's actually not. When you can make such a great bearish case, it becomes its own bull case in some weird way. It's what you said. It's backwards, upside down, inside out.
It is. And honestly, credit to the guys at FundStrat, the folks at FundStrat. They have been talking about this is the most hated V-shaped rally since the end of April.
Yeah.
Okay.
People usually like making money in the stock market. They don't seem to be enjoying this one.
Yeah. And I'm like, no, I mean, I was trying to, we were on the horn with clients during, that early part of April. Get in, we want to buy this with both fists. In fact, we had a client call one of our advisors today and say, hey, do you have something we can put our money in that's a little safer right now? And we said, sure, we do. If that's what you want to do. And he said, is that what you think we should do? And I said, no, I think you should bring more money right now. We need to buy this with both fists right now. That's what I would do. Okay. That's what I'm doing.
Yeah.
So I'm buying this. I'm not selling this. Right. Yeah. Because this is opportunity. This 12, 15, 18 months out is an opportunity. Okay. Yeah. That's how you have to, but to be fair to the general public who doesn't think and see it that way, they don't necessarily have access or understanding of the data that we do because we're in it every single day and we have these very expensive tools with all this information that we know how to aggregate and infer. Right. So once you have that, you have the experience like anything else, like driving an 18-wheeler. Backing into a tight place. It's tough because I had to do it. It stinks. Yeah. But once you get good at it, it just takes practice. And then you're fine. Then it's just you whip that thing in there. No different.
Have you really had to do that before?
Yeah, our race cars it's a 16.
Oh, yeah, that's right.
Yeah. Well, it's got, let's see, 8, it's got 4, 6, 12. Yeah, it's an 18. No, it's got 6 on the back.
You have to go count.
It's got 8, 10. It's a 16-wheeler. So the truck's got 10 and the trailer's got 6. So it's a 16 one, but it's 75 feet.
Yeah.
It's a big one. It's a big baby. So I have to park that thing at the RV parking at my house, which is man, you want to talk about,
which is harder
at the same time, huh?
Yeah, which is harder. And I think I know the answer to this without even asking it, but which is harder, driving your race car down a drag strip or driving the truck to get the car to the racetrack?
Driving the truck to get the car to the racetrack is exhausting.
Yeah.
Okay? I mean, you're like,
Yeah.
and now to be fair, okay, don't throw tomatoes at me through the screen here. We have a driver that does that, right? Because but parking it at my house is kind of my thing. That's the hard part. Driving the race car, is after your eyeballs come out of the back of your head and you can see again, it's a lot of fun.
Yeah. Well, and it's I just had to drive a U-Haul a couple of times, and it's mentally exhausting because you're so used to being able to check your blind spots and be able to see the angles and everything are so much different once you have the trailers and stuff back there. I can't imagine.
When you drive that big truck like that, I mean, when you're driving that truck down the road, because I've driven it here and there, like local areas, and it's a big boy, right? Yeah. I can feel my mustache growing. So manly, so good. By the time I get out, I look like Tom Selleck.
Yeah. Immediately have to go shave it off. So
yeah, I mean, well, if I get any older, I'll look like Wilford Brimley, but you know what I
mean. Oh man, well, good to see you. And are we going to do a show next week after Thanksgiving?
I hadn't thought about that. I mean, we're going to be close, so probably not.
Okay, probably not. So I'll see you in 2 weeks. Yeah, I love the way you. The client asked, do you have something we can put the safe in? And you said, yeah, we can if that's what you want to do. They said, is that what you would do? And was there any hesitation at all?
No, absolutely not. We buy.
Yeah,
we are bulls. Like, you see that back there? There's a bear in there.
That's right.
There's a bear in there.
Yeah.
But that bull's raging.
Yeah. Well, that's a great segue into the disclosures. So Matt's very smart, very good at what he does. But he doesn't know you. He doesn't know your financial situation. So don't do what he did just because he said that's what he did, because he doesn't know what you should do because he doesn't know you, right? Did I get that right?
That's correct. Okay. You need to consult your own advisor or hire us as an advisor. That's right. Where you pay us money to give you advice, and then I can give you advice. I'm not giving you advice right now. I'm just trying to entertain you with my anecdotes and truck driving nonsense.
That's right. This is just for fun. But if you would like to do it for real and talk to Matt and his team, you can give them a call at 702-655-8200 or visit intelligentinvestment.com. I think that's all we've got. I'll play the official disclosures here. But Matt, good to see you. I'll see you in a couple of weeks. Happy Thanksgiving. I would say not to eat too much, but I'm going to eat too much 2 or 3 times. So I hope you have a great Thanksgiving. And we'll see you on the other side. I guess that'll be in December. So we'll see you then.
I'm gonna absolutely go comatose on Thursday, 100%.
I always say I'm not going to, and then I always do twice. So I don't mean to, but it happens. Overindulgence. Yeah, can't. It happens. It's part of it. All right, man. Good to see you, buddy. I'll see you in a couple of weeks.
Bye-bye.
Bye.
Discussions in the Intelligent Investment Show are for educational purposes only. The information presented should not be considered specific investment advice or a recommendation to take any particular course of action. Always consult with a financial professional regarding your personal situation before making investment or financial decisions. The views and opinions expressed are based on current economic and market conditions and are subject to change. There is no guarantee that any statements of future expectations will come to fruition. All investing involves risk, including the potential for loss of principal. Securities offered through United Planners Financial Services, member FINRA, SIPC. Advisory services offered through American Retirement Planning Group, ARPG and United Planners are independent companies. Garrett Lill and Wealth Partners are not affiliated with ARPG or United Planners. Any endorsement that I may have given during this recording, it is important to note that I am not a client of ARPG. The views expressed should not be considered representative in any way of my past, present, or future experience with Matt or ARPG. No incentives have been provided to me in connection with any endorsements I may have given on the Intelligent Investment Show. Investing involves risks, and there is no guarantee of any future results, performance, or success.